Let's be honest, when we see India VIX spiking towards 22, 23, 24, our first reaction is probably to sit down and avoid trading. From so many months, even I was looking for opportunities to how to trade in a low VIX environment. And suddenly out of nowhere, we are seeing such an high VIX. So what kind of trades can be done in such an high VIX? We said let us find it out, analyze what has happened in the past, and let's see what can be done in such scenarios and learn from it. Welcome to another video by the Option School, and I am your friend Pradeep Singla. Disclaimer: all the content in this video is purely for educational purposes and no recommendations at all. First, let us see what happens when VIX rises. We all know that with rising VIX, option prices definitely increase. And when I'm saying option prices increase, it's true for both call and put. Relative pricing increases for both call and put. And when this high VIX settles down, which eventually it will, we all know that option prices will crash also. As an option seller, definitely you're looking for such opportunities wherein the prices of options are very high. But high VIX, high prices can also mean that okay, markets will be swinging wildly. So it is definitely dangerous also. So definitely it becomes a big paradox whether I see such high VIX, such high premiums as an opportunity, or whether I see such high VIX, such wild movements as a risk. Let us find it out. Let us try a strategy which can utilize these high VIX premiums but still has low risk in case market swings wildly. The strategy name is butterfly. Please note I am talking about butterfly. I am not talking about iron butterfly. I will try to test a call butterfly in such a scenario. Let us quickly understand what is a call butterfly. Call butterfly has basically four legs, but then three parts. Part one is that you buy one lower leg, which is shown here, and then part two is you sell two legs which are higher than the first leg what we have purchased. I will show you an example also. And then part three is buy a still out of the money leg. So you buy one leg, sell two legs, and buy one leg. So generally it is also known as one to one strategy or call butterfly strategy. All the legs are of call only. We are not involving any puts in this strategy. A similar trade can be obviously done with puts only. So that strategy will be known as put butterfly strategy, where one to one trades are taken with the help of puts only. In my back testing, I have tested a scenario where market had gone down, and once market has gone down substantially, obviously the VIX has gone up. So both the things are there: market going down, VIX going up, and then there can be an event, there may not be an event. But if both these things are there, we said okay, let us try in past whenever this has happened, will that call butterfly work or not? Although if I see technically, both the conditions are very good scenario for a call butterfly. But is it just conceptual? Is it just theoretical? Or whether it works practically also, we need to test it. So we said, okay, let us find out a scenario in the past where we can test it and let us see what happened. Please hit the like button for better reach and visibility. I am really grateful for each and every valuable like. Before going for a back testing, let us see few features of call butterfly. First thing is, what is the margin requirement? Margin requirement is roughly around 70,000 rupees, 1 or 2,000 rupees here and there depending upon the strike selection. And then it's a defined risk strategy, which means that okay, whenever I'm creating this call butterfly, I know what is my maximum risk if things do not go as per my planning. And then what is the reward? If risk is 1, whether the reward is 2 or 3 or 4, we will see that. So if it is a good risk reward ratio, then only it makes sense to create such a strategy. Otherwise, high VIX environment, market reacting to some events, it's better to stay out only unless and until we get a very good risk reward ratio. I just created one trade on Opstra to check what is the risk reward ratio. So what I found that okay, for a max loss of around 96.75, there can be a profit of around 35,000 rupees. So roughly around 1 is to 4 risk reward ratio. Then definitely this kind of a strategy is doable. Let us now have a look at a real example from previous data. Again, I'll request you please note that okay, it is a low risk strategy. It is not a no risk strategy. Hardly there can be any strategy which can be identified as no risk strategy. So it has to be little bit of risk, but yes, the risk should be a calculated risk. So for back testing, I selected June 2024. VIX was at 26. Only thing we can note is that okay, lot size was 25 at that time. So we have done it in three lots to make it 75. In this scenario, since VIX had increased, we wanted to create a trade that benefits from falling VIX. It's a known fact also that generally if market rises, VIX will decrease. Although in today's markets, anything is possible, even in rising markets, VIX increase. But generally it has been seen that okay, if a market has fallen and then from there, if it rises, the increased VIX will definitely drop. So to take benefit of this falling wicks, we said, okay, let us select a slightly bullish trade. Trade should be such that, okay, if market rises from here, wicks should fall and it should give me profit. But in case market keeps its lower move, falling move, then the loss should be very limited. So we selected this call butterfly wherein one call was purchased, two calls sold, and one another call was purchased. And we have done 3 6 3. So what is the risk reward ratio? Risk reward ratio is 1 is to 4.5. There was a green profitable area of around 820 points of market, and just see India VIX at that point in time was 25.9. So what is the maximum risk in this trade? If we can see the payoff diagram, maximum risk is around 6,600 rupees. Whatever happens to the market, whether VIX from 25 goes to 35, whether market falls by another 2,000 points, whether market goes up by another 1,000 points, maximum risk is defined as those 6,600 rupees. But we are just taking a chance that in case market comes up and it falls into that profitable zone, whether we can have profit or not. Just after 2 days, market went up by 250 points and VIX came down. So India VIX from 25 became 17.85, and we can see the instant result. The trade was in a profit of 42 points, which is around 4.3% based on the capital deployed. And if the trade is maintained till 24th of June, although as per payoff diagram, we are not at a very great situation. We are not in the center of the trade. Market has gone up by 900 points. But what has happened is VIX has came down from 25 to 13.6. And even if the market is not in the center of the profitable trend, still we are making 80 points in this trade, which means on capital deployed, this is a profit of around 8.5%. So even after a move of 900 points, which is quite high, due to fall of VIX by 90%, the trade was in a great profit of 8.5%. So ultimately in options trading, it is all about identifying the right opportunity and matching it with the right strategy. Let me check our understanding. Is call butterfly a debit strategy or a credit strategy? Write your answers in the comment section and feel free to ask any questions you want to ask. Do join our silver membership to get exclusive videos on options world. You can join by clicking the join button given below. I am leaving you with another great high VIX strategy video called ratio spread. You will definitely like it. Do hit the like button and the subscribe button. Download TOS app from link given below in the description. See you in the next video. Bye.